being publicly streamed.
So, hello everyone, welcome to this week's live session. And in today's session, we are going to cover like the option theory, which was covered in week 10 and 11. So we will try to cover all of that in today's session. Okay. So options is in the last session also we discussed some options, like there are two types of options: put options and call option. Okay. And what is a call option? Call option which give you right to purchase, and put option which gives you right to sell. Okay. And there are these are few features associated with a option. Like a option will have an associated strike price. It will have a expiry date, and other features which impact the price of options are the interest rates, stock price which is there for the underlying stock or underlying whatever asset on which this option is given, and volatility of that particular underlying asset. Okay, these are the few factors which impact the price of a stock. So let's first take two examples, one for call option and one for put option. And these are the notation which we will be going to follow throughout this session. Like for strike or exercise price, we will follow capital X; for expiry date, capital T; for interest rate, small r; and for stock price, we will follow notation of capital S. Yeah. So for example, like in this way, a option may be defined like a 6-month call option on Tata Motors with strike price of rupees 900. So these are three features which define an option. So 6 month is the expiration time, or this strike price of 900 is the capital X, the exercise price, and the underlying stock is Tata Motors. So whatever the current price, so let's suppose the current price of Tata Motors is, let's suppose, 950 rupees, then it will be the Tata price, stock price. Similarly, a put option. So put options, for example, like a 3-month put option on Wipro with the strike price of rupees 400. So 3 month is the expiration time, 400 is the strike price, and the underlying asset is Wipro. So, and interest rate is the risk-free interest rate which is there in the market. So for example, let's suppose in India, the risk-free rate is 5%. So the on the government bond, whatever rate is there, so we will take that as our interest rate. Okay, we will see like how these things play a role in option pricing. And these are the relation of put and call option price with these variables. So call option increases with all the variables except strike price, and put option increases with strike price and volatility, but decreases with interest rate and stock price, and its relation with the expiry date is uncertain. So it has been extensively discussed in the lectures, but we will come back to it once we go through some formulas, then we will see like how we can relate these relations with the formulas which we are going to study. Okay, so now let's first like the check the payoffs, like how payoff means what will be the value you will get from this call option. And in payoffs we are not considering the cost, so payoff is without cost. So without cost means we are not including the price of call or put options while we are like evaluating these values. Okay, so when so suppose you have a call option. Okay, now X is the strike price and ST is the stock price. Okay, so if my strike price is more than stock price, in that case you will not exercise your call option. That means you will not use your right to purchase this. Why? Because let's take this example only. So let's suppose if my Tata Motors stock price is 850 rupees in the market, but I have a call option which has a strike price of 900, and so at this stage, like at the expiry, this is the values. So if I am a rational person, I will go to the market and purchase the Tata Motors stock at 850 rupees, not exercising the option and purchasing it at 900. Correct. So if my strike price is more than my stock price, then I will not exercise my call option. So in this case, it is out of the money. Out of the money. M stands for money here. And when strike price is same as stock price, in that case, like whether you exercise or not exercise, in both case, your like the payoff will be zero. So it is up to you. So it is add the money. So add the money. And like when my market price is higher than my exercise price, in that case, if you exercise your call option, then you will earn a payoff of st minus x. How? So let's suppose like current market price is 950 rupees. So what you do, you go to the market and you exercise this. So you will be able to get this Tata Motors stock at 900 rupees, and in the market the price is 950. So immediately you exercise option, get the stock as at 900, and in the market you will sell it for 950. So in that way you will earn a profit of st minus x. St is the market price at expiry and x is the exercise price. So in this case it is in the money. Similar exercise if you do for the put option and all the values reverse. So put option give you right to sell at a particular strike price. Correct. So in that case, like when my exercise price is higher than stock price, in that case my put option will be in the money, and I would leave it to you to think like why this is in the money, how you will get profit by exercising the put option. In this case, when my stock price is same as the exercise price, then it is put option is also at the money. And when like in if the market price is, let's suppose in the second case, if the market price is 500 rupees and you have a put option with strike price of 400, then why would you sell at 400? If you are having crypto and you exercise this, so you will get 400 rupees, but in the market you will get 500. So you will directly go to the market, not exercise this put option, and in this case it will be your out of the money. Okay, so these are some basics. And from the exercise point of view, there are two types of options: European and American. European, which can be exercised at the expiry date only, and the American, which can be exercised in between also. But throughout these lectures and throughout this course, we have like the taken the case of European options only. We are not considering the American options because it's intuitively you can see like those are more complicated to exercise, more complicated to play with, because there are a lot of things involved also. Okay. Now let's like look at the payoff diagram, like the how these payoffs. So with options, like there are two types of options, call and put option. And with these options also, you can take two types of, like either you can buy the call option or you can sell the option. Correct. So we will take this for permutation combination, and we will see like how my payoff behaves in all four cases. So first take the case of buying a call option. So you are going to the market and buying a call option. So this is also called the long position on the call. So in short, we call it long call position. Okay. So let's suppose C is your call option price. Okay. So first we will try to draw the payoff. Okay. We have seen earlier also like when my X is less than ST. So when my ST is greater than X, so first I will mark the X, the exercise price. So if my stock price is more than X, then my payoff is st minus x. That means it is a linear function with st, so a positive linear function of st. So in that case, like my payoff is this curve. Okay, and if it is less than x or equal to x, then my payoff is 0. So this blue line is my payoff. So I have drawn the payoff. Now if I want the profit, then what I will do, like I will subtract the call option price, because when I am buying, I have to pay the cost. So if C is my cost of, C is the price of call option, then I will subtract. So at each point, you subtract this C call option price at each point, then you get this green colored graph, which is the profit from buying a call option. So this green curve is your profit curve for a long call position. Understood? Any doubt with this?
Yeah, we
Okay.
can proceed, sir.
Okay. Now let's take the other side of this trade. So if you are buying, there will be someone else you who will be selling this call option. Okay. So selling the call option is also called like writing an option. So if someone says I write a call option, then that means he is selling a call option. And in short, we like in other terms we call it a short call position also. So what will be the payoff diagram in this case? So till x, like option, if my stock price is less than capital X, then my option will not be exercised and payoff will be 0. This blue curve is the payoff. Okay. But when my stock price gets higher than this capital X, then the payoff will be like for this. So if stock price is more than X and if stock price is less than X, in this case it is 0. In this case it will become, because now you are selling, then the person who has bought this call option from you, he will exercise his this call option and his payoff will be like negative of what if you have bought this one. So if we draw this, so in other words, it is x minus st. So it is a negative -1 slope line after x. Okay. So this blue curve will be my payoff diagram if I am writing a call option. So, and if you want to draw the profit diagram, so for profits, like now you are selling, so that means you are getting the option price or the option premium upfront. So you will add this option price with your payoff, and this green curve will be your profit diagram for selling a call option. Similar analysis you can do for like the long put and short put position, like buying a put option and selling a put option. So when you are buying a put option, so what is the payoff for a put option? We have earlier said it, like when my stock price is less than exercise price, then my payoff is x minus st, and other in other cases 0. So when my stock price is more than exercise price, then it is 0. So in this case, in this region, it is 0, and earlier it is x minus st. So it is a -1 slope line before prior to this. Okay, and here also, like if you want the profit, then you will subtract the price. So this is pp is the put option price. And similarly, you can do this payoff diagram for short put position also, like when you sell. So when you sell, when my stock price is more than exercise price, put option will not be exercised, payoff is 0 in that case. And prior to that, payoff will be negative of what was under the long put position. So in this region, your payoff will be st minus x, correct? Here it is negative because x is more than st, so it is negative. And here, like you are selling, so you will get the premium upfront. So this is the premium you are getting upfront. So these are the four payoff diagrams which you should know how to get like what these means with very simplistic way. Okay, now using these payoff diagrams we will delve into some option strategies. So in order to like manage my risk in my portfolio, so like how we can use options in order to manage the exposure towards any type of risk. Okay, so when you go to the market and when you purchase any stock, so what is the risk? Like if the stock price goes down, then there is a risk because you will make a loss. So our objective is to like when you buy a stock, then you should minimize your loss potential. Okay, you put a cap on your loss. So how do you do that? So there we will mainly study three strategies. First one is the protective put. And that what you do, like you purchase a stock and you purchase a put option on this stock price. Okay, and put option has like some expiry date and capital X exercise price. Okay, so now what will be the payoff of this portfolio? Like this creates a portfolio stock plus put option. So there will be two cases when my stock price at expiry, when my stock price is less than exercise price or greater than exercise price. So my stock value will be the same because stock value is whatever the price of the stock at that time. So in both cases, stock value is capital ST. But my put option payoff will be like if it is less than exercise price, it is X minus ST. In other case, it is zero. So overall, my payoff is like X minus ST. So I have somehow like put a bar on my maximum loss. So this is my payoffs. Okay, so my minimum payoff is capital X. Maximum, like here my price is going up, so upward potential is there, but my I have put a lower bound on my. So if I have only taken this stock, so it will be ST. So ST is going down. So here ST is lower. So I have put a bound. So let's take a look at it through the payoff diagrams also. So for a stock, what will be the payoff diagram? So it will be a like the positive sloped like line because with ST its value also is ST. So this is the payoff diagram of a long position of a stock, like when you buy a stock. For a put, we have seen like you are purchasing a put, so your put long position on put has this payoff diagram. So in this region, it is this. Okay, and now so here like you if you combine these two curves, then your payoff diagram becomes like when your stock price is less than exercise price, it is capital X till that point, and to if you go beyond that point, then your payoff like increases linearly in this region. Okay, and when if you want to find the profits, then like you just need to subtract the cost of your portfolio. So what will be the cost of your portfolio? Cost will be initial stock price plus put option price, correct? So you will subtract these two are fixed, so you subtract a fixed amount from this payoff diagram and you get this green curve as your profit diagram. Okay, another strategy which we study which we also can use for hedging our long position on a stock is called the covered calls. So in covered call strategy, what we do, like you purchase a stock, but instead of buying a call option, in this case you sell a call option. Like in protective put, you buy the put option. Here you sell the call option. Okay. So let's take a look at like first we draw the payoff diagram for stock. It is upward sloping line. For return call, here we have drawn this like this is the payoff diagram for return call. So we add these two curves. So what it becomes? So here like my payoff diagram for like beyond X, my payoff is capital X, correct? So I have put So there is upper bar on my profits, but as well as I have put like the, so by I have put the minimum bar on my loss also. So my maximum loss will be 0 here only. Okay, so how you get it? So my payoff diagram here becomes like, if I combine these two, so till X, I get a linearly increasing payoff from this stock position, and the upward, this one is the flat curve beyond that. And if you want the profit, you just subtract the cost. So in this case, cost is S naught minus C naught, correct? Because minus C naught, because you are getting this call option price upfront. So negative C naught will be your cost in this case. And the third strategy which was discussed in the lectures is called the straddle. So in straddle, what you do, like you purchase do not purchase your stock, you just play with options. So you buy one call option and one put option, okay, with same expiry and same strike. So how will this play in our case? So what will happen here, like here you will benefit with decline in the price as well as rise in the price. How? So with call option, this is the payoff diagram. With put option, this is the payoff diagram. When you combine both of them, then you get like this blue type of your payoff diagram for straddle. And if you subtract the cost, the cost is your put option price plus call option price. So you subtract this. So this green curve is your profit diagram. So and you can do this analysis like when you will get your, so this is also positive, this is positive, this is positive, and this is 0. So have built a you have built a strategy which gives you a positive payoff in each case. Okay, this is the payoff. You need to subtract the cost to find the profits. Okay, please take a note of that. If question asks you for the profit, you need to subtract the cost as well. Okay, so in these three cases, this is the case. So your payoff is positive in both the cases. So you are benefiting from the price decline as well as price rise. But like if you take in the terms of profit, so at the exercise price, you make the maximum loss, which is negative of your put option price plus call option price. There are two other strategies which I leave up to you to analyze, like for like you need to make these three cases, what will be your profits and payoffs, and I recommend you to draw these payoff diagrams, like how these strategies behaves in these cases. So the first strategy is called the strip. In this case, what you do, like you purchase two put options and one call option with same strike and same expiry, and another is strap. In that, like you purchase two call option and one put option. There are a lot of other strategies also for risk management, but in this course, like we cover a like the tip of the iceberg only, and these are the 5 strategies which were discussed in the lectures. So you should understand like how to analyze these type of portfolios which involve options also. Got it? Any doubts, any questions till now?
No,
Okay.
sir, we can.
So next topic was which was discussed was the put call parity. It is a very important result in our finance finance theory. So what this established? So this establishes a relation between call option and put option price, and we will see like how it comes out. So let's first take two portfolios. One is your protective put portfolio and another portfolio which we are building using a call option and a risk-free bond. Okay. So risk-free bond will earn you like the RF, rate of return, in one period. So for protective put, we have already done this analysis. The payoff is like when strike price is less than X, then it is X and ST. In the case of bond, so bond will have a fixed value. So bond, we have purchased a bond such that like in the next period, it has value capital X. Okay. So its present value will be X upon 1 plus RF. Okay. So we have taken a bond at this price, and finally its value has come down to this. So the bond value in both cases will be the same, X and X in both cases. And call option, like if it is less than exercise price, then it is 0. It is more than this, then it is ST minus X. So these two portfolios have same payoffs, like in both all the cases. We have covered all the cases. Okay. So both have same payoff. So according to the no arbitrage theory, what should happen? So if two portfolios have same payoffs, then they should cost the same. If they do not cost the same, then there exists a arbitrage opportunity, and like you will be able to earn free profit. So we do this analysis. So price of this portfolio is equal to price of this portfolio. So price of this portfolio will be like C naught plus this present value of my bond. So bond means like you are borrowing from the market. So this is your call plus bond portfolio, and this is your put plus stock cycle. So this will be your put plus stock. So this is my put call parity relationship. So what it does, so it establishes a relationship between call option, put option, and other features of these options like the exercise price, risk-free rate, expiry date, and the stop price. Okay. Now in the earlier, I have said some like relation between call option price and put option price with these variables. So here one variable is missing, which is volatility, but still like remaining four, you can do check like whether that relation holds or not. So you can see like call option price is positively related with this like the S naught. So with the stock price, it goes up. It if you take this side, so it becomes negative. So it has a negative relation with exercise price. So it goes down with exercise price going up, and with RF, so in negative and beyond. So with RF, it has a positive relation. With T, it has a positive relation. So all those relations which we established earlier, you can verify with this put call parity formula. And later we will discuss the Black-Scholes formula also, and you can verify those relations with that also. Okay. And now like this RF, like this RF, so here it's because we are this T is your period. So and RF is given in the annualized term. So if it is said like this, R is continuously compounded, then you replace this compounding with the continuously discounting. So the continuous compounding put call parity will be C naught plus X e to the power R, negative RT plus V naught S naught. So this you should take a note. So if in the question it says like the interest rate is continuously compounded, you should use this formula for your calculation. And what type of questions you can expect is like there are multiple variables in this equation. You will be given some of them, and you will be asked one of them to be evaluated. Suppose you will be given call option price, this, and this, then you will be asked to find the put option price with same features. Okay. So this was the put call parity. And next topic which was discussed in the pricing of the options, like we discussed one option pricing method thoroughly, which we call the binomial pricing model. So what is binomial pricing model? So binomial comes from by like there are only two possible. So in this case, what we say like my underlying stock, whatever that is, So it can take only two future values. Okay, so let's suppose only one period is there. Okay, so currently stock price is 50 rupees, and this stock price can either go up to 60 rupees or it can go down to 45 rupees. These two are the only possibilities. Okay, and the risk free rate is given to be 10, and I, for simplicity, we take like 1 year to be my time period, and this is my annual risk free rate. Okay, and what my task is? My task is to find the call option price, which is 1 year maturity and strike price of 55 rupees. Okay, so how this option pricing model works? Like we will go through 2 3 methods through which we can evaluate the option price given these like the features. So first is like you build two portfolios, one with the options, one without the option. So one portfolio which, and what should be the features of these two portfolios? Like these two should have same payoff in each case. Okay, so earlier you would have seen like here what we did, like both of them had the put option and call option was there in this put call parity, but here what we need, like we need to create two portfolios which have same payoffs, but one has options, one do not have options, and we will do the same thing. Like if payoffs are same, then their cost will be the same, and from that, like we can get the price of the call option. So here what we do, like here you have to do some like the practice and exercises through which you will get hold of this method. So how you build these two portfolios? So first portfolio is like you buy one share of the stock and you borrow like the amount which is equal to the down amount, so down stock price, so that much you will borrow from the market. So you borrow 45 rupees at 1.1, so you borrow in such a way like in the next period that borrowed amount equals to 45 rupees. Okay, so I do the discounting and get like the, I need to, if I borrow 40 rupees and 91 paisa at 10% interest rate, in next period I have to give away 45 rupees. Okay, I borrow this amount and I purchase one share. Okay, and other I will buy three call option. So I will see, we will see like how we get these three call option. But at first, like let's analyze these two portfolios whether they satisfy our criteria or not. So if you borrow, so next period you have to, you are borrowing, next period you have to like they give it back. So you have to give back 45 rupees, whatever be the like the stock price. Second is like second is like you from the stock, like whatever is the stock price. So if 60, then value of your stock is 60. If it is 45, then it is 45. And the call option which you had, like it has the strike price of 55 rupees. So if my in the next period, if my stock price goes down, then call option will not be exercised and its value will be 0. And if price is 60, then you will exercise and one call option will give you value of 5 rupees. Okay, so in 60 case you have 5 rupees as your value, and in 45 case 0 is your value. Okay, so this is for one call. Okay, so you like the for first portfolio you sum the first two rows. So in this case you get 15, in this case you get 0. So here from one call you are getting 5, you want to equate the payoffs, so you get 3 call options. So that's how we get the second portfolio. Now the payoffs are same, so these two cost the same. So the first one has the cost of 3 call options. It should be equal to what is my cost of my first portfolio. So I purchased at the initial price. Initial price was 50 rupees, and plus I borrowed. So, so I think I made, so this should be, so right 3 call option. And second, like if you, so your cost is minus 50 and you borrowed, then this is your port, like the payoff in that case. Correct. So from that, like you get your call option price to be 3.03 rupees. Correct. So in other way also, like, so earlier was correct. Yeah. So when you buy three call option, your cost is 3C, and so when your cost from, like, if you purchase one stock, your initial cost is 50, and you borrowed this much amount, so you had upfront this much amount, so you subtract this from your initial cost, so your cost, this is equal to 9.09. So if you divide it by 3, you get your call option price to be 3.03 rupees. Okay, so this is one way to find your call option price in binomial pricing model. Other way is like, in the class, professor has given you a, like, the well behaved method, like you just follow those steps and you will be able to solve for the call option price. Okay, so what you need to do first, what you need to do, like you need two ranges. First one is for the stock price range and one is the option payoff range. So stock price range is like, in the next period, what is the range of my stock prices. So my stock price either go to 60 or go to 45. So range is 15 rupees. And option payoff range is like, what is my, there are two possible payoffs, payoffs for my option. So if my stock price is higher, then my option payoff is 5. If it is lower, then my option payoff is 0. Then I got my option payoff range. Okay. In the next step, what to do, you find the hedge ratio. How do you find? Like you just find the ratio of these two, like the option payoff range and the stock price range. So if you do this, then you find your hedge ratio to be 1/3. And what this hedge ratio means? So hedge ratio means, like, if investor writes one call option, that means if he sells one call option, okay, and if he holds H amounts of stocks, then the resulting portfolio which he will get, its value will be unaffected by the stock price. That means, like, either stock price is more than exercise price or less than exercise price. In both cases, his value or the payoff from this portfolio will be the same. So he will get a certain payoff with this portfolio. Okay. So that is what we are going to do. We will create a portfolio of H shares with one written call option. Okay. So H shares means 1/3 shares or stock plus one call option. So for simplicity, what we do, like we get these stocks to be like the both these numbers to, like, if you multiply a portfolio to a constant number, then also, like, it will give me a certain payoff. So I multiply this payoff portfolio with 3, then I get this portfolio. So these two portfolios are similar in a way. Okay, their cost, like if you just divide it by 3, then cost will be the same. Okay, so if I multiply by 3, so I get a portfolio with one stock and 3 call options. Let's analyze this. So how this portfolio behaves, whether this has a certain payoff or not. So there are two possible prices, like either up or down, 60 or 45. If it, stock will have whatever the price is there. So stock will have 60 in this case, 45 in this case. 3 return calls. So 3 return calls will have, like, the payoff of, you have written, so payoff will be negative. So here, like, you will get negative of 60 minus 45 as your, what am I doing? This is 55. Sorry, because exercise price is 55. So 3 return call will give you like 3 times of this payoff, and your total payoff will be 45 in both the cases, 45 in the first case and 45 in the second case. Okay, so your payoff is fixed. So what in the next step, what you do, like you find the present value of your certain payoff. So present value will be 45 divided by, like we are discounting with the risk-free rate, so that is 10%. So from that you get present value to be 40.91. You set the cost of portfolio to the present value of the certain payoff, that is 3C plus 50, because minus 3C, because you are getting these call premium and you are giving this much price for the stock, so this should be equal to 40.91, and you solve this equation for the call premium or the call option price, and in that case also you get call option price to be 3.03. I will be back in 1 minute. If you have any doubts, please do let me know. Hello. Yeah, sorry for that. So then, so we have seen two methods to solve for the option price, and we have taken the example of call option. And another way is to following the risk neutral approach, what we say. So in that approach, what you do, it is the shortest way in my opinion. So what you need to do, you need to find the risk neutral probability of upward price movement. That means, like if if my economic environment is risk neutral, then what is my probability that my price will go up? So price go to 60 in this case, in our example. So how in the class we derive this formula for risk neutral probability, that is equal to 1 plus risk free rate minus the downward movement divided by up minus down. So this up and down are the the ratio of price movement. So the up will be, up in this case will be 60 by 50, and down will be 45 by 50. Okay, so these are the ratios of my final price to my initial price, and if I put these values for my, for our example, so that will be 1 plus 10% minus 0.9, that is a down movement, divided by 1.2 minus 0.9, that becomes 2 by 3 is my risk neutral probability of upward movement. And next what we do, we use this probability to find the expected cash flow from my option. So what is the expected cash flow in this case? So that becomes, and I discount it with the risk-free rate, the risk-free rate. So what is my expected cash flow with this risk neutral probability? So that will be with 2 by 3, it goes up. So in, if my price is 60, then in that case my call option payoff is 5 rupees, and if price goes down with 1 by 3 probability, call option payoff is 0, and I discount it by 10, the 10% interest rate, and in that case also I get my call option price to be 3.03 rupees. Okay. Please take a note, like this is not the real probability. It is the risk neutral probability. Okay. So these are the three ways in which, like, you in the exam you may be asked like the to solve for one or any intermediate step. So it is better like you understand all these three methods. And now once we understood this risk neutral approach, we can use it to solve for multi-period models. And in the class, I think we solve for 2-period and 3-period model. And for higher period model, the Black-Scholes formula is there. So we will look into that. So for a multi-period model, so for example, if like my option is expiring in 3 months and there are three possible price movement there. So my tree would become here, this goes down, this goes down, this goes up down. Okay. Okay. So going up means these are my these these dots are my nodes. That means at that point price changes, like price either go up or down. And we take like this up or down movement is of the same amount. So like this U and D are fixed throughout all these price changes. So here like there are three different type periods. So there are three steps up to my expiration. So my delta T would be 1 divided by the number of participants. So my delta T is the 1 by 3 in this case. So if there are 3, so delta T is 1 by 3. All other variables are the same. Is my natural logarithmic number, Euler number. Okay. So just evaluate this. It will give you the risk neutral probability. And once you got the probability of upward price movement, you can use that to find the expected value of my call option at the expiry. Let's suppose like it was 50 here. Okay, it goes to 60. Let's suppose up movement is this only. So it goes up by 20%, goes down by 10%. So here it becomes 41.5. So you can compute it like 60 times 1.2 becomes 72, etc., etc. You can do the multiple. So what will be the final price says, you can also evaluate that also. And in each case you can compute the call option payoff. Okay, because you know the exercise price, you got the payoffs, you know the probability because you computed the upward price movement. So it will be P, then it will be 1 minus P, it will be P 1 minus P, and you got the cumulative probability. So if price goes up 3 times, then its probability is P times P times P. Correct. So you got the payoff, you got the probability for all. There will be 8 cases, and you compute the expected price, and you discount it. You get the call option value. But for the exam purpose, you can leave the multi-period models as of now. So, but why I wanted to show this, because in the real life, like the stock price goes up and down, like each moment it is going up and down. So with each second stock price is changing. So there are multiple sub periods up to the expiration. Okay. So if there are more and more sub periods, let's suppose there are infinitely many sub periods, then stock price at the expiry, it approaches to a log normal distribution. It was given by this two people, Black and Scholes. And so if this follows a log normal distribution, then the price of the call option can be written as this functional form. Like C naught is your call option price, S naught is your initial stock price, X is your exercise price, R is your risk-free rate, T is your expiration date, and D1 and D2 are these two variables where the sigma is the standard deviation or the volatility of the return on the stock. Okay, and this capital N, it represents the CDF of normal distribution. And D1 and D2 are these values. All other variables are the same, which we have described here. Okay. Now the key point to note here is like this ND1. ND1 is the value which is getting multiplied with S naught for call option. And that means like it gives you the value, like if stock price changes by some value, my call option price is going to change by ND1. So let's suppose stock price goes up by 1 unit, then my call option price will change by ND1 unit. And in that sense, we call this ND1 to be the delta of the call option. And if we compare this value with our binomial pricing model, this is same as the hedge ratio in our binomial pricing model. Okay, you should take a note of this. And if you try to derive the same Black-Scholes formula for put option, so in that case, your put option formula becomes this one. So here, if you notice, like the coefficient with your stock price is like minus of 1 minus ND1. So ND1 minus 1. Okay. So these ND1 and ND2 are the normal CDF. That means these are the probabilities. ND1 and ND2. ND1 and ND2. These two are probabilities. Okay. That means like these values lie between 0 and 1. So ND1 minus 1 will be a negative value. So that is true also, like in the at the start of our class we have shown like the put option price goes down as the stock price rises. Okay, so delta for a put option is negative and delta for a call option is positive. Okay, and I would recommend you to like go through this formula and look at like the relationships which we earlier established. So call option goes, let me use this one. So call option goes up with this one, it goes down with this one. So it is in the negative exponential. So negative I will denote with this, and it goes up with R, it goes up with this, and with D1 it sigma comes like in square up and sigma down. So overall with sigma it has a positive relationship. So with sigma it has a positive relationship. So in other words, like in the lectures also professor, so like if there is higher volatility, that means there are multiple possible chances that my option will be in the money. So in that case, like option has higher value. So in both of the cases, price, if there is higher volatility, that means it has higher chances of getting very huge payoffs. That in that sense, like the call option or the put option value, both the options have positive relation with the underlying stocks volatility. Similar analysis if we do for the put option, then with exercise price it goes up. Okay, with these two, like with interest rate it goes down. Okay, with R, with expiration date it is uncertain because this expiration date comes in this ND1 and ND2 also, and these are have negative and positive relation with this. So for call option it is certain because it has a positive relation with both T, with the here and here also, but here like with D1 and D2 it has a positive relation, but here it has a negative. So overall relation with T is ambiguous for put option, and with S naught it has a negative relation. Okay, so these were the relationships which we established earlier, and we have done this comparison for using these formulas as well. Okay, these were the topics for our option theory which were discussing week 10 and 11. Okay, and for practice, like there are ample questions given, and we will have some practice problems like in the next session. Like all the topics which we discussed, we will have some practice problems on that. Okay. Any
Yeah.
questions?
Yeah. Thank you.
Okay. Okay. See you next week then. No?
Yes, yes. So for n term, can you able to?
Sorry for
Hello.
enter. Yeah, for enter.